Wyckoff rules. That means two things, maybe more. Wyckoff has rules. It's a methodology. It's an approach. It's quite old. Many people see it as being archaic and old-fashioned. I think it's been absolutely ideal, magnificent, and spot on in being able to navigate the recent market environment. And I've tried to document that in the last few months. The other thing is Wyckoff rules because of those very things. It is a great methodology, a great approach. It's hard work. It takes a lot of effort to learn how to do the Wyckoff method. It is a mastery process. And many people, none of us, we're all just great Wyckoffians, and we work really hard at it. And it's a work in progress for all of us. But for many, they just simply want to know what to do and when to do it. And I completely understand that. People are busy working hard. And but Mr. Wyckoff said, you know, if you don't have time to understand the real rules of the game, then it's best just not to play it. And a lot of people simply choose not to understand the real rules. And Mr. Wyckoff was very careful about revealing the real rules, which Wall Street does not want us to know, understand, or use. Hi, I'm Bruce Fraser. I'm your host. Welcome to Power Charting. So let's start with just a quick update. GDP. GDP today, first quarter, was announced minus 1.4%. Some of the estimates that I look at were expecting positive 1.1%. Fourth quarter, I believe it was 6.9%, going from 6.9% to minus 1.4 one quarter to the next seems to me like hitting the wall at a very high rate of speed. And that's painful. So we may be approaching recession conditions very, very quickly. CPI plus 8.5%, most recent reading year over year, very high. The Fed is trying to address that as best they can. These are very hostile environments. Here you can see in this decennial pattern that the 1 and 2 year of the decade tend to be generally the weakest. And in fact, we can certainly say that going in from the first year, end of the first year into the second year, we can see that the markets have been quite weak, and here we are now in the second quarter. And this tends to show up sometime around mid-year. Now, if you look at the average typical stock, many stocks are performing much worse than the indexes, reflecting maybe the look of this decennial pattern using the Dow Jones as our proxy. So keeping that in mind, this is a very hostile environment for the stock market. And these conditions up here are not helpful for stocks. Now, having said that, there is a bullish case to be made here in the near term. I just want to show you this because I think Wyckoff, very old methodology, people kind of poo-poo it. I totally understand that. I think it's absolutely been totally relevant, the best way to approach this market in the last couple of quarters. And here, the whole notion of Wyckoff is trying to identify the characteristics of internal strength inside of weakness. And in an uptrend is to identify the conditions of exhaustion and conclusion of a trend in an uptrend. Now, why is this a paradox for investors? Because sentiment is such, and here you can read more about distribution definitions in an early blog of mine. And here are the schematics. Check these out and read more. But I want to talk a minute just about sentiment, because you can see here that sentiment is a paradox for investors. And it's one of the reasons that this is one of the most difficult businesses there is. And if it was easy, everybody would do it well. But very few people really do it well. Very few professionals can beat the S&P 500. And most professionals simply closet index, and NASDAQ 100, the S&P 500, and so on. There are some very good investors out there, and they are available. You have to do your research. But extreme greed shows up, well, when does it show up? It shows up at periods of very high prices. Extreme fear shows up when prices are falling and low. And so emotionally, people operate as a crowd. And when sentiment is quite fearful, that often represents the environment for low risk buying opportunities. When sentiment is very high, what the fear and greed index at CNN calls the greed period of greed, this is a period when you have very a lot of optimism and so on. Here's two examples. Here's the fear and greed index when it gets over 80%. This is the fourth quarter of 2021. Here is the put call ratio, very high call activity occurring here into the highs of the market in the fourth quarter of 2021. This is the S&P 500. So very high prices. Paradox is a period when the most people are bullish. So this is a problem. Opinion makers, market analysts are very bullish when the prices are most extreme at their high tippy top levels. And so this is the ultimate paradox. And we need to be able to act independently of that. The reason that we as Wyckoffians will follow the footprints of the composite operator on the charts. We will use the charts to analyze what's going on. And from that, be able to determine their motives, their incentives, what they are doing. And so technical analysis is a phenomenal methodology because we can follow the charts. Well, many technicians are identifying this distributional structure, and they're starting to really see it. But when was it best to be able to identify the conditions for a top? So here are these distribution schematics again, and you can see here now these charts are actually constructed in February, but I want to point out that the distribution schematics work so well in this most recent market environment. And we have talked about this in the past. I did it on Your Daily 5. I did it here in Power Charting. We went through really event by event by event. And we actually started to talk about the difficulty in this market when it became overbought in September, had a very important big reaction into October. And the trouble really began back then. And remember that the highest optimism for the market occurred in the fourth quarter. Everybody was in the glow of good news back then. Well, that's when the trouble was really starting. So here, and we've been looking at those put call numbers for years, and we use them. They're wonderful as environmental tools to tell us when conditions are either very bullish or very bearish on a sub-intermediate and intermediate basis. So I really encourage you to become familiar with those. And here you can see on the left is the NASDAQ 100, the big mega cap names, which we've been following very, very closely. And on the right, you can see the S&P 500. And here is the evidence or the documented unfolding of those distributional structures. And we were talking about them when they were occurring. So let me give you an example. And so here you can see we're talking about the question of a last point of supply occurring, but we'll come back to that in a minute. Here is a point and figure chart that I put up in August 13th. And at that time, this is one of the important Wyckoffian tools as horizontal point and figure counting. I've created a system or a method to be able to do ratio scale, logarithmic scaling point and figure, which is a log scaling advancement that is really a benefit of the computer age that we can do. And notice these beautiful reaccumulation counts all the way up from 2011 in the S&P 500. Now, I show this most recent count which goes from 2018 to 2020, and it counts up, and look where it goes. It goes right into the vicinity of the important high that was created here. And this is was published in August. So note also, if you look closely, there's a trend channel here and a throw over of the trend channel in August. That's an overbought condition. It's a throw over, overbought, with a point and figure count that confirms that area as being the area of the high price. Now I'm going to show you an update here, and this is what in fact happened. We went one box above the high count on that count estimate using logarithmic scale, and then the distributional structure formed thereafter. A beautiful example of how we can incorporate all these elements of vertical bar chart analysis and point and figure, ratio scale, logarithmic scale, point and figure, and so on. And so here we can see climactic blow off, now range bound. Okay, and so this came as of, actually, I think I updated that in January. So it's not even up to date, but I do want to show you that we were really on top of the evidence of weakness masquerading in strong uptrends in the conclusion of a market. Here is the SPY, S&P ETF, and here is a swing trading count. This is 2019-2020. This is a daily chart. You can see this is a much smaller time period that we're counting here. 475, 495. Look, we went right up into the objective range. So I want to show you there's more than one way. This is a standard scaling chart, user defined. These are 5-point increments in the SPY, but this is more traditional scaling, not logarithmic scaling. Okay, so now here, let's move on and let's look at the triple Qs. So the triple Qs, you can see a throw over and an overbought condition that occurred there in late 2021. And that gave us the throw over distributional structure. I'll look more closely at that. You saw a chart of that a few slides ago. And here there was a distribution count that was formed. That's the purple line right here. And this purple line actually had a fulfilled count, went to 318.26. And I think it might have gone down a little bit lower than that. But here, this is a blog I want you to go look at, which was published November 28th. And this was a beautiful point and figure chart of the triple Qs NASDAQ 100 ETF with reconfirming counts. This purple count down here went up to an objective range. Then another reaccumulation count, smaller, confirmed the larger count. They confirmed each other on a throw over and an overbought condition in the upward stride of the market. And so using this reverse use of trend lines approach, beautiful structure. And let's see what happened next. And we see that it came right back into the area of the top. Here is the distribution, initial distribution. I think it could be larger than this potentially, but for now, we are working with this as our count, and there is a count. Look what we did. We went right down to the area of this support level in the triple Qs, and in fact, this did stop the decline, and it has been range bound literally ever since. And so these are things that I suggest you go look at. Go look at those old blogs that I did. And let's take a minute now. I want to talk to you about a great upcoming program. Wyckoff Analytics is going to have Gary Dayton, and Gary Dayton is just a great Wyckoff trader who is also cutting edge instructor, teacher on trading performance, mindfulness, and cutting edge psychology, has written a fantastic book on this very topic. He's going to do a 3-part educational series on this topic for Wyckoff Analytics. I encourage you to go to wyckoffanalytics.com and go look at this, check it out, and then participate. 3 weeks, 5/3, 5/10, and 5/17. All right, so while we're here, let's look at these blogs. So here is the blog I wrote on November 28th with the point and figure objectives showing this stair-stepping higher. And I just can't imagine anything doing as good a job as the Wyckoff approach for being able to identify the exhaustion of an advance in a rising trend. And I really want to emphasize this because this tool, this whole methodology has been so useful to us. And I've done my level best to attempt to communicate this to you, my wonderful community, and be able to share these experiences. And also, I really want to emphasize the incredible difficulty of this business because of the contrarian nature of it, and the fact that into that high on that throw over in October, November, as you saw in some of the sentiment numbers, there was just a glow of goodness, a glow of joyfulness about higher prices. And it was a time to be incredibly careful, somewhat defensive, tighten stops, do the things you do to protect your capital, because the business that we have is to protect ourselves and to be able to ride through the difficult times so that we can then participate in the next good times whenever they come, in the next however long, year, 2 years, it could be 6 months. But we want to be survivors. As a professional portfolio manager, which I did for many years, if we were in alignment emotionally with our clients, especially at the extremes of the highs and the lows, we were doing something wrong. Our clients needed to be uncomfortable with us at the highs when we were raising cash, becoming defensive. They needed to be uncomfortable with us at the lows when we were starting to put cash to work and taking on risks because the risks were demonstrably low. And this is the job of a good portfolio manager, and it's very hard emotionally to do. Most portfolio managers, they really want their clients to love them, as I wanted my clients to love me, but I needed them to love me for doing a good job. And I have had clients that effectively fired us, our firm, because we were doing the uncomfortable thing. Didn't happen very often, but I've had examples of it. I've had other great manager friends who have had the same experience, who are doing an absolutely terrific job. And that is how you create a great track record over a long period of time. So I'm just telling you, these are the experiences. This is what it's like out there. And so just be willing to walk alone. It's a lone wolf game, as Dr. Hank Pruden used to say, and be willing to be out there on your own, making your own decisions and protecting your capital first and utmost. Now, while we're at it, let's go to, here is a March of 22 blog that I did. And I want to show you this because note here, as we were going through the markdown phase into support at this area right here on this trend study, that we were coming into the area of support. And I was making the case at that time that potential green shoots were emerging. And so this was a point of maximum pessimism, huge put buying. People were very, very pessimistic into those lows, new lower low. And I even did a daily 5 called Searching for Green Shoots. Go check it out. You can go right into this blog and just link to that. Well, what happened next? So then we came back and said, okay, here is what ultimately happened. And after that low was put in, we did have those green shoots identify an important advance up to the area of resistance. It was the best rally of the year. And that was fantastic. But we also note that up here we said, is this a last point of supply question mark? Like this one, that's a point of a high and a reversal down. And you can see that there's a climactic gap in this throw over of this resistance area above these two prior peaks, and then a turn back down at that point. Well, here is a 2-hour chart, which shows in more detail the green shoots base. Go look at that video because you can see some of the internals that helped us to see the improvement, the rally up, the throw over, an up thrusting action with the climax, and then a turn back in again. Well, what happened next? We can go in, let's start here. Let's click on this chart and you can see this is what happened next. Sure enough, a very sharp, quick, high volume decline right back down to the area of prior support where this sign of weakness formed. And that's exactly what happened next. So this was strictly a swing trading opportunity. We thought that at the time, and here we are again. And is it possible that we could have some kind of a good low here and a turn back up? I'm hopeful for that, but there's less evidence today than there was prior. And so now going back to this area here, let's look at the 2-hour. Let's bring this one up to date to where we are. And this is the same time period. We'll look at this decline in the persistency of it. This has a climactic quality in this drop. And let's be looking for green shoots in here for the potential for some kind of a larger accumulation that might be developing from maybe even a better rally. And so time will tell, but that's what we're going to be looking for. And also, conversely, for weakness, the characteristics that this is really has no demand inside of it, and that we could have another decline to lower prices. And so we will be watching this closely, and I heartily encourage you to stick with us on this. I also want to point out that when I wrote that earlier March blog, that I wrote it right when this rally was putting in a beautiful gap on a surge up above the support area, and right as this downward trend line was being exceeded. So this was a really the ideal place for, you know, a conservative swing trader to participate in that rally. Okay, so with that, hang on just a second. I will be right back. Let me also show you this point and figure chart. This was a chart, again, this was from early mid-March, and here is a potential structure, a cause building process. I want to emphasize this local distribution that was into the highs. Look at the throw over, and this is daily data, 3-box reversal, 25-point scale for the S&P, throw over, overbought. We talked about that from other perspectives, and then account built. A lower high was formed, last point of supply, downward it went. It went right into the range of the sign of weakness low at 41.25 and built a cause. There's potentially 2 causes here. I believe it might be bigger now. So I want to just show that this was the count I took right at the point of the emergence above this downtrending line. And this in fact proved to be the point at which the rally began, which we just looked at, and it rallied up right into the range of this count, which I flagged at the time, and it rallied up into this zone, and that's where it stopped, through over these highs here, through over this preliminary supply point, and then we saw how it went back down again. So with that, one more pause, and then I'm going to show you one last chart that we'll finish. Okay, one last chart, and then we got to run. We're out of time. Here is that local distribution count that occurred into that throwover here of the rising trend line. This count we took in two phases, here and here. This is a 60-minute 3-box method chart of the S&P. Went down to 4140, 4065. At that time in February, it had gotten as low as 4114. And in fact, I think that it got down, well, here is that 4114 right over here. So here is the count into the low. Showed this actually in your daily 5. I want to bring all this up to date, and here it is. And let me turn this timer off, and I'll leave you with this chart of these counts. And here is a local distribution count. It's been fulfilled. And with that, thank you so much for being here, and we will see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.